Good morning, everybody. It's 10 a.m. and it's time for our weekly webinar. It's April 18th, tax day. Happy tax day, if there's such a thing to be happy about. But here we go. So as we always do, I'm going to go over the same format. So first, I'm going to ask you, if you haven't already, to hit the like, subscribe, and notification button on your YouTube channel. And we're going to break it down like this for our weekly webinar. So we're going to have our about 15 minutes of our IRA updates from the Ed Slott group, and that is timely information about IRA withdrawal issues, maybe new tax law updates, maybe some other updates about things that affect your retirement distribution planning. And that is an area that I frustratingly learn day after day that most tax professionals and most financial advisors just don't pay attention to. So the withdrawal of your retirement accounts is just vitally important. And if I could just have one wish today, it would be that more and more financial professionals, whether they're even attorneys and accountants and certified financial planners or other financial advisors, if they just got on board with this important part of your withdrawal strategy, I would just love that. But so we're going to go over those updates from the Slott group, and then we're going to talk about the markets for about another 15 minutes. And then we're going to shift into our financial 15, which is our financial planning topic. So if you're staying with us for the entire webinar, that's great. If you want to just forward to the financial 15, you can do that. All the webinars are indexed. That is, if you're not watching it live, and hello to everyone watching it live. John, good morning. Good to see you. But that's the breakdown. And then on the YouTube channel, you'll see this webinar live for at least a period of time. And you'll see the financial 15 separately with the same topic. And today's topic is, should you roll over your 401k? And for today's purposes, when I mention a 401k, I mean your other retirement plans, your 403Bs in particular, or your other employer-sponsored retirement plans. So I just didn't want to list them all out. So you'll see 401k in the email. At least I sent you 401k ... So just to include the others, but we're not just talking about 401ks today. And there are considerations, and I'll share with you that this topic became much, much larger than what I had expected when I sat down yesterday to write it out. But I'll try to keep it condensed for you. So Slott group information, market updates, and then our financial 15. So let's get started with it. Let's talk a little bit about our upcoming events. So we have our big event, our next big event, May 16th with Ed Slott himself and Dave McKnight himself, both best-selling authors. And it's going to be a great event at the Newtown Theater, and we're going to have about probably 2.5 hours of the best minds in IRA and retirement planning space for you, for sure. So join us if you can at the Newtown Theater. It's May 16th. I believe the starting time is 6:30 p.m. So we're going to talk a little bit about headlines. So last Wednesday, so the day after our webinar, the March Consumer Price Index report came out, and that is the basis for inflation. That's what measures inflation. That comes out from the Bureau of Labor Statistics, and you can go through and see exactly which type of service or product inflated at different levels. But the overall inflation level was 5% year over year. So there's been a nice steady decline year over year or month over month as we're seeing inflation. So hopefully what the Fed is doing is working. And we'll talk a little bit more about that in our analyst reports. So as I mentioned, today is tax filing deadline for 2023. That's April 18th. It's also the deadline for your tax payments, also the deadline for your first quarter estimates. Also the deadline for traditional IRA contributions for 2022 for a previous year, or Roth IRA contributions for the previous year. So a lot of important deadlines today. All right, let's jump on down to our, I'm going to share my screen here, and we're going to talk about the Slott updates. So you have in front of you our this week's Slott updates. So you'll see that yesterday, our friend Sarah, I chatted with Sarah quite a few times last week, but I did invite Sarah also to our event coming up on May 16th. Sarah lives in the Philadelphia area, so I was hoping she could join us because she's wonderful and she's very knowledgeable, and she helps me tremendously with you all and our clients. But she can't do it because they're going to be in Chicago. Dave and Ed are doing an event separately in Chicago a couple days after that. So Sarah's going to be out there helping to prepare for that. So, but I'm not going to read this entire article, this Roth IRA versus Roth 401k. I'm just noting it because I think Sarah might be watching our webinars because we did a webinar about this Roth IRA versus Roth 401k a few weeks ago. So I appreciate that, Sarah. And I appreciate all that you do for us. But if you're interested in information about Roth IRA versus Roth 401k and what the difference is, not really competing, but what the differences are, then you can go and look at those webinars or that webinar that we've had from a few weeks ago. And if you don't know how to access our webinars, you simply go to attleborowealth.com and you go into webinars and I think it's webinars and events. And then there's a drop down for weekly webinars and special webinars. So the special webinars are normally have a special guest, like our latest was with David McKnight about a month ago, and or I'll just do a special topic. So I've had a lot of great special guests, and we've also sometimes just focus on one topic. Like instead of just 15 minutes or so of a financial planning topic in the financial 15, I'll do a deeper dive and talk for maybe an hour about something. And if you're just listening, you won't be able to follow along. Many of you I know I've heard or listen rather than watch on YouTube, but I use the whiteboarding quite a bit, so it may make sense if there's something you hear that you need more information on. You may want to go back and watch the video. So follow along with me. We're going to talk first about the year of death RMDs and Roth conversions. That's from today's Slott Report mailbag. So Andy answers the mailbag this week, and you can see this just came out on April 13th, so very timely. So the first question, Andy Ives, is both of my parents passed away last year. My mother passed earlier in 2022, and I was able to take her year of death RMD, required minimum distribution. That's the amount that the IRS tells us we must take out of our IRAs, our own IRAs or inherited IRAs. And it's a factor that I've shared with you that, and you can find the table on our website, attleborowealth.com. But that is an amount that the IRS tells you must take out of these accounts. And if you don't take them, your penalty will range now, new penalty, anywhere from 25% to 10%, depending on when and how you correct it. So this person writes, I was able to take her year of death RMD out of the inherited IRA before the end of the year. My dad passed in October, and once I got the inherited IRA transferred over in December, I forgot to take his year of death RMD until January of 2023. So mom passed earlier in 2021. This person was able to take her year of death RMD. And then, unfortunately, his father passed, and by the time he got the inherited IRA transferred in December, he forgot to take the year of death RMD until January. So let's see what Andy says about that. Well, let me finish the question first. What forms will I need to complete to request a waiver of the penalty? And would this be a good cause for a waiver? So Andy writes back, sorry for the loss of your parents. Some good news is that you do not need to request a waiver for missing your dad's year of death RMD. As of last year, the IRS granted automatic waiver for a missed year of death RMD penalty if the RMD is taken by the beneficiary's tax filing deadline. So that's today. But on this one, including extensions. So if they extend it to September, October, I guess it is, then they'd be able to wait until then. Since you took the RMD in January, the year of death RMD has been satisfied and no forms are needed. Really great answer to that question. And that's a really obscure question. It just shows you the depth of knowledge and responsiveness of the Slott group. And I can't talk about how much I appreciate them. I'm going to be seeing them next week, spend a lot of time with them next week. So I'll have some good information for you coming out of there. The next question is regarding Roth conversions in the 5-year rule. So the question is, I converted an IRA to a Roth IRA 7 years ago. I want to convert more IRA money to a Roth in 2023. My age is 64. When I convert the additional IRA to a Roth, I will one, will I need to wait 5 years for this second conversion before I can take out any money? And two, should I create a new account for the second conversion to keep the second conversion separate from the first conversion done 7 years ago? I'm getting different answers from different financial advisors / CPAs. So that's the part that gets me there. But because the 5-year rule is pretty darn simple, especially when you get past 59 and a half. But it just goes to show everybody who's watching this video or listening to me here, you have to work with a qualified advisor, whether they're a financial advisor, a CPA, or an attorney. You need someone who knows what the heck they're doing. And I'll talk about that a little bit in a moment. But so this person's getting different answers from different financial advisors and CPAs. And the question is, I already have an IRA. I converted it more than 7 years ago. And I want to do another conversion. Do I have to open up another IRA account, a Roth IRA account? And does the 5-year rule start clicking again? So Andy writes, Clay, the definitive answers are this. No. Definitive answers. I like that he says that. No, you do not need to wait 5 years on the second conversion to take out any money. The entire balance is immediately available, tax and penalty free, including any earnings. This is because you have had any Roth IRA for 5 years and you are over age 59 and a half. That's again referred to as the 5-year rule. It's more complicated under the age 59 and a half, but it's very simple over 59 and a half. If you've had any Roth IRA more than 5 years, your conversions are free to come out tax-free. Your contributions are free to come out tax-free, as they always are. And your earnings are free to come out tax-free because you've satisfied that 5-year rule. Very, very simple. Why it jams people up, professionals, I just don't know. And two, no, you do not need to create a second account for the second conversion unless you want to. He can, if he'd like to. There's no restrictions, no requirements on how many Roth accounts you have. Whether you maintain multiple Roth IRAs or not, the IRS does not care. All they see is one consolidated Roth IRA under your name. So the IRS looks at it as one big account, even if you have 15 of them. 15 is not the maximum number. I don't want anybody to get that impression. I'm just using a large number that popped into my head. So really great answers there, Andy. And let's continue with this. 5 reasons to open a Roth IRA immediately. Again, written by Andy Ives. Andy writes, time is running out. The tax filing deadline is Tuesday, April 18th. That's today. Why is this important? Because that is the last day an IRA can be opened and or funded for the previous year. Even if a taxpayer files for an extension, that does not extend the prior year IRA contribution deadline. With that in mind, here are 5 reasons to stop procrastinating and open a Roth IRA immediately. Now, please don't call us and ask us to open and fund a Roth IRA for you today, because it's not going to get done. So Andy wrote this last week, but I think it's timely, especially for you folks that are listening after the tax filing deadline, because there's always next year. And if you believe in the tax efficient process and paradigm, where we believe the taxes and the math supports it, the taxes are going to be significantly higher in the future, probably by 2020 or 2030. Excuse me, 2020's past. Probably by 2030. The studies I've done show that the average middle-class American is probably going to be in the 40 to 45% effective tax rate. So pay those taxes now while it makes sense, and you can choose the tax rate that you're using. But if that's the mindset and the planning that you're doing, you want to get, and you don't have a Roth yet, you want to get that opened so that you start that 5-year rule running. Okay. So I do see that I am doing this blocking. Okay. So Andy writes, get your clock started. I'm down here at number 1. So I'm going to move it back up. I'm right here at number 1. Get your clock started. As mentioned, the deadline for making prior year 2022 contributions to a Roth or traditional IRAs, April 18th of 2023. If you already filed your taxes, you can still make a 2022 Roth IRA contribution without having to amend your return. That's a great point. So get it done. Even if the contribution is for a small amount, like $100, that will start your Roth IRA 5-year clock ticking. And if you designate the contribution for 2022, you get a January 1st, 2022 start date. Your 5-year clock just became a 3-year, 9-month clock. Great point. Great point. The magic, number 2, the magic of compounding. I'm right here. The longer money has to grow within your Roth IRA, the more tax-free earnings you stand to accumulate. And if more accumulates now, then more can potentially compound on top of that. Albert Einstein famously said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Another popular saying is, it's not about timing the market. It's about time in the market. And then number 3, Roth 401k destination. If you have a Roth 401k and plan to roll it over to the Roth IRA at some point in the future, you will need to open a Roth IRA. But if you never had a Roth IRA, and if you wait until the last minute to establish the account to accept your rollover, your 401k dollars will adopt the 5-year clock of the Roth IRA. Yes, qualified plan distributions that can soften this blow. Yes, qualified plan distributions that can soften this blow, but why wait? I don't even know what he's saying there. Establish a Roth IRA now for any future Roth 401k rollover is really, again, a really smart idea. If you think that you're going to roll over your Roth 401k in a few years, establish that Roth IRA now. There's no harm. You have to pay attention to account fees and things like that. Many companies have, custodians have, $40 IRA fees, $50 IRA fees, even more. So be careful about that. But there are plenty of custodians who have no fees. And if you need some guidance on where they are, you can email me at admin@attleborowealth.com, or questions. Send it to questions@attleborowealth.com. But no reason other than those fees I talked about to not to open up that Roth account and prepare for that rollover. Leverage a conversion. You may make too much money to contribute to a Roth IRA. Well, there are no income limits on Roth conversions. That is a common confusion also. Let me say it again. There are no income limits on Roth conversions. Anyone with a traditional IRA is eligible to do a Roth conversion. It does not matter if you make $0 or $1 million. It does not matter if you participate in a work plan or not. Yes, a conversion is taxable and will add to your earned income for the year, but all future growth is tax-free. Also, a Roth conversion starts your initial 5-year clock just like a Roth IRA contribution. Only difference is a Roth conversion cannot be labeled as a prior year conversion. Great point again, Andy. I can't wait to see Andy next week because I got to tell him how great his articles have been. You will receive a January 1st, 2023 start date, but at least your Roth will be off and running. Really great. Last one, Roth IRA distributions, ordering rules. I don't want to hear any excuses about locking up my money or what if there is a financial emergency. Roth IRA distributions follow strict ordering rules. Contributions come out first. So what that means is if you contribute, let's use this year and you're over $57,500. And for some reason in 6 months, you need that $7,500 back. You can take that right back out. The IRS has they say that contributions always come out first. Even if your Roth value is now $8,000, let's just say it's grown to $500. There is no complicated formula. There's none of that. The IRS says the contributions come out first. The conversions come out second. Last is any growth. So Andy's going to tell us again, contributions come out first, then converted dollars, then earnings. A person only has access to the Roth IRA contributions, tax and penalty free. Converted dollars are available after 5 years, regardless of how old you are. If there's a true emergency, there's a good chance a portion of your Roth IRA will be available for withdrawal. No strings attached. The time is now, only a few days left. Okay, we're past those days, but really great information, Andy. Let's talk about investments. Let me just pause to see if there's any questions before I talk about investments. All right. Jerry, I'm just going to read Jerry's comment here. Moving out of a 401k to a self-directed IRA opens the advantage and disadvantage to making individual stock picks. What outcome have you seen most in your experience? Thanks, Gerard. I don't develop individual stock portfolios. I think that we can be much more efficient and simpler if we use exchange traded funds, low cost exchange traded funds, and in some cases where it makes sense, mutual funds. But I don't have any specific experience. I'm sure there's been plenty of people who have rolled over 401ks and made poor choices in stock holdings, Jerry, with their IRAs. But that goes back to having some professional guidance. I think everybody should have professional guidance. It's just what who that professional is, and I'm going to talk about. Oh, before I move on, so before I get into investments, let me talk about a situation that occurred last night. So this was this. I got an email from a common person who commonly follows this webinar. So if you're on this, hello. The email went something like this. There was a previous email asking about modified adjusted gross income and Roth contributions. Excuse me. Well, conversions and Roth contributions. And the person wrote, my modified adjusted gross income is too high now to make Roth contributions because of the conversions I did. So let me see if I can lay this out. The person said, my modified adjusted gross income is too high now to make a Roth contribution. So it's hitting against that phase out level, right? For a married couple, 218,000 to 228,000, I think it is, off the top of my head, but of modified adjusted gross income. So I can't make a Roth contribution, this person said, because of that. Otherwise, I would be below that threshold if I didn't do that conversion. And I wrote back, well, good news. The Roth conversions don't count against your modified adjusted gross income for Roth contribution purposes only. So if you make, just to keep it simple, if you made 118,000, and I should have that chart up because I hope those numbers are right. If you made $118,000 and that was your modified adjusted gross income, and then it did $100,000 of conversion, you might assume that now you're over. And I may have talked about this last week. So 128,000. And I think I did the same thing last week. But 128,000 added another 100. You might assume that now you can't make that contribution. But what I'm telling you is that the IRS allows for a subtraction of that Roth conversion amount when you're considering your contribution level and if you're below the phase out level. So I hope that makes sense. And I do think if you need more clarity, I think I actually sketched this out on the whiteboard last week as I'm talking about it. Well, so I had that conversation and shared that with this person. And person's not a client. He just listens all the time. And he should be a client because he needs some guidance. But so this person properly went out and found a CPA. I'm thinking a CPA, tax preparer, because you got to have your team. You got to have a qualified financial advisor. Should be a certified financial planner. I think if you're in if you're planning for retirement, it should be somebody who focuses on tax efficient and effective retirement planning. But you also need a qualified CPA, and you need at least a good estate attorney, and should probably be an elder law attorney as well. But this person at least went out and found who he thought was a qualified CPA. But the email he sent me last night was puzzling. The email said, "Well, my CPA wants me to pay for this Roth contribution. It's going to be an excess. He's seeing it as an excess contribution, which requires a 6% penalty." It was about 9 o'clock or so. And I was so confused by this guidance that he was getting. I said, "Are you free for a phone call?" And we had a phone call, and I asked him to explain it to me again. And sure enough, this tax preparer is saying, okay, well, if you're going to make this Roth contribution, it's going to be considered an excess contribution. Therefore, you're going to have to pay a penalty. But that's first of all, it's completely inappropriate, and it's also not how it works. You don't plan for an excess contribution. It has to be something that is unwound, right? Because you're going to be paying this penalty year over year over year, and it doesn't make sense at all. And by the way, he's completely wrong. The CPA is completely wrong because, again, he was falling back on the idea that he couldn't make this Roth contribution because the conversion took him over the phase out levels. And the person's question was, I can't find anything. And I guess the accountant didn't do any research about it, but within, and we hung up the phone, and I said, okay, just for my own peace of mind, I'm going to go find the tax code, and it's tax code 590-A. And in that tax code, and I hope I have that right as well, but I think I do. But in that tax code, and regulation, it shows there's a worksheet that clearly subtracts out Roth conversions for a calculation of modified adjusted gross income only for Roth contributions. So the moral of the story, folks, is yes, have your team together. You want that team working for you. You want qualified individuals, but for crying out loud, make sure they are the right people. They need to be qualified individuals. They need to understand this. And it is unbelievably frustrating to me that this person took the time to seek someone out, is paying this person, and is getting horrible advice. So, I hope that doesn't upset the person who I'm using as an example. I didn't name you, but it's not you, sir. It's you're professional, and it's frustrating. So back to investments. All right. So last week was a good week. The Dow Industrial Average grew 1.2%. The S&P 500 grew 0.82%. The NASDAQ was up 0.30%. The MSCI World, except for the U.S., so the world index was up 2.27. So across the board, I'm going to stop reading them. Across the board, bonds were down about 0.5%. So the aggregate bond index is up just about 3% for this year, much better than it was last year, but still not a whole lot of growth there. But they're considering it a bond rally because, it's a positive, right? So when you read some of these analyst reports, you hear about the market rally and a bond rally. Now, some areas of the market are up big so far this year, 8.29% for the S&P 500, 16% for the NASDAQ. The international growth has been very, very good, 11.26, 11.58, 8%, 5%. So that's all good. Areas of the U.S. market seem to be trailing a little bit, but so as interest rates go up, bond prices sometimes fall, and we saw that last year. Now, I'll give you some insight. We've been introducing bonds back in our portfolios, and some clients are asking us, well, why bonds now? You've been saying, be careful, bonds are one of the most difficult areas to manage, and they certainly are. And we've taken steps to help us with management of that, all of our portfolios. We engaged a research firm, and they help us research and develop and implement in our portfolios, and that's been great. So we started that in January, and at some point we'll have a group call with a couple of the folks from Cornerstone Portfolio Research. That they're the group that we hired to do that on our dime. Not our clients don't pay for that; we pay for that. So. That no extra costs. I don't believe in that. Some people stack that on, and I'm going to have a conversation about that, about how to choose a financial advisor and what you should be looking for. But what was my point? But so we've been introducing bonds back in our portfolios for the past month or so, and we think that as interest rates are stabilizing, that it's a good time to start introducing the right bond holdings into the portfolios. All right, so. The Fed funds rate, so interest rates by the Fed funds rates were the same week over week. They haven't increased, but the 6-month Treasury was up, about 0.16%. So it went from week prior 4.81 to 4.97. And as did the 2-year, went from 3.98 to 4.10. So they all interest rates, as far as interest rates you get on Treasury bonds, have increased. Continue to increase or fluctuate, I should say. So speaking of Cornerstone, so Cornerstone gives us a weekly research report, which I like, and they talked about the consumer price index or inflation. So consumer prices at the consumer level rose 5%, as I talked about, year over year in March, they say, just below expectations, while the core rate raised 5.6%. We've talked about the differences in that before. That was right in line with expectations. They write, inflation at the headline level is easing but remains sticky at the core level, which keeps potential further rate hikes in play for the time being, in their opinion. So Cornerstone thinks that the Fed will continue raising rates. I think that's a pretty fair assessment. So we have We talked about last week about the producer price index, which is basically the cost of making goods, right? And they write positive inflation news continued with wholesale prices increasing 2.7% year over year, the smallest year over year rise since January 2021, while falling about a half a point month over month, right? So from last month to this month, it was down a bit year over year. So this time last year to this time this year, it's up about 2.7%, both of them below estimates. So they say, Cornerstone, another positive reading showing inflation easing for the Fed to consider. Okay. BlackRock had an interesting point today. Stocks and bonds have rallied both this year. See, they're calling 2.47% a rally. Stocks and bonds have both rallied this year. Some see this as a reason to return to traditional portfolio approaches like 60% stocks, 40% bonds. They say that is not a recommendation. This is just what they're saying, BlackRock. Those used to work when both assets trended up and bonds offset equity slides, they write. We think a focus on any one asset allocation mix misses the point. A regime of higher volatility with sticky inflation needs a new approach to building tactical and strategic portfolios. We see the appeal of income, get more granular with views, and more nimble. I agree with BlackRock 100% with that. You have to abandon this generic 60-40, 70-30 asset allocation model. Asset allocation is an important part of the three pillars I talk about, but you've got to lay in asset allocation, principal protection, and account segmentation, and these have to be driven by your plan and your needs. So try not to invest in a vacuum. You've got to have your investment, your financial plan drive your investment needs. And one of the best ways to do that is using the three pillars. And from a planning point of view, if you can have some guaranteed income, that's going to help you tremendously as well. Wrapping up, I'm just going to read this entire excerpt from Empower. So Empower talked about how, that there was this, I'm an Air Force vet, and there was this Air Force airman in, I forget where he was now, in New England somewhere, I think it was, but it seemed that he was trying to impress some gamers, right? So some internet gamers. So he was leaking some top secret information, some sensitive government information during his gaming. And this has got him in a world of trouble. And they talked about how he was trying to earn some street cred by releasing this information, and it's going to cost him big time. But they applied it to the Federal Reserve Chairman, Jerome Powell, which I just thought was kind of, it made me laugh when I read it, but he wrote, the author of this article writes, I imagine, excuse me, that on at least some level, Federal Reserve Chairman Jerome Powell can relate to what this person did trying to get some street cred. Powell and his Fed have just spent over a year trying desperately to restore their own street cred after utterly destroying it with a self-inflicted wound. You might recall the whole really inflation is transitory. Remember, they were calling inflation transitory. And still here we are dealing with this month or after month and year after year at this point. It was as epic an example of self-perpetrated foot shooting as you're likely to find anywhere, this author writes. But now 12 and a half months and 475 basis points, which is 4.75% of tightening later, which means they've increased the interest rates 4.75%. Powell's Fed may finally have results they can point to if they hope to restore some of their former swagger. Increasingly, it's beginning to look like they might have actually succeeded in bringing inflation under control. Last week's CPI data was lighter than expected on the headline and in line on the core, while the PPI was comfortably lower than expectations on both lines. And I talked about that earlier with Cornerstone's reports. So what they're saying is the Fed has to get some credibility back. They made some, they tried to use these clever words, transitory, whatever's going to sound better for people about inflation. Well, inflation's really high now, but it's transitory. And then they threw away that word and they said it's not transitory. This is something we have to deal with, and we have to get to work to help bring it down. And hopefully increasing interest rates is starting to work to bring down inflation as we need it to be. I was watching something on the CNBC this morning, and Dr. Jeremy Siegel, who I really respect out of Wharton School. He said he thinks inflation is already where it needs to be. We just haven't seen it yet, and that was an interesting take. I don't know if I agree with that, but okay, moving on. So here we are. We're a couple minutes behind, so I'll have to move through this quickly. But we're going to switch to the Financial 15, and we're going to talk about should you roll over your 401k. I do have a question before we do that, and Debbie writes, not to go off subject, but would it be wise to buy some silver or gold outright due to the direction the world is going? I'm not going to talk about that, Debbie. I appreciate the question, but I'm not going to talk about that in general. If you want to schedule an appointment, you can do that, and I'll give you my thoughts about it. But my general thoughts are it's good to have representation across all markets and with proper asset allocation, which is the pillar one of your 3 pillars of investment management. You'll have that with good asset allocation. So I've just moved, if you saw some commotion here, I've just moved this down. And if you're just joining us for the Financial 15, we're going to talk about should you roll over your 401k, and those 3 dots mean and other plans, and so on. So, or your other plans. And I put some notes here, but I just want to share with you how big this is. And I'm sorry, if you're just joining us for the Financial 15 on YouTube, please hit the like, subscribe, and notification button so that you're kept up to date on everything. And if you want to look at or listen to the entire broadcast of our weekly webinar, you can also find that on YouTube. So there's 2 other portions to that before we head into this Financial 15. But let's dive into the Financial 15. And that is, should you roll over your 401k? So there are many things to consider here. And in fact, the regulatory agencies just put out a checklist about a year ago that we have to go through and identify. And I just put some notes here, but let me just share with you. I've got some resources, and this is what I mean. This became much bigger. Where the heck did I put them? There we go. So first of all, I went to our, the Ed Slott group, and they have this whole checklist of things that is 7 pages long. And they have this whole pros. I actually tried to condense it, but even that was getting a little more than I want to deal with over on this call today. But it again just shows, first of all, how big this topic is. So the things we're going to talk about are not going to be all inclusive. But what I think are the vital things, some of the vital things to consider when you're considering rolling over your retirement plan or 401k. But it's not everything, and I can't quite. I'm going to cheat a little bit with you folks here. Look, here's the 7 pages of the checklist, and this is just one example. So this is what Ed and his group called modules, and we go in and if I'm searching for something, what are the pros and cons? Like I did yesterday, what are the pros and cons of rolling over a 401k to an IRA? And there are 7 pages of considerations here. Really, I just can't say enough about the resources of this group. So let me get back to my points here. So first of all, I want you to understand that if you roll over your 401k or other retirement plans, so if I say 401k, just assume I'm referring to other retirement plans. It's a tax-free transfer. Please don't let anybody tell you, because sometimes we get bad information from the people on the phones when we pick up and talk to our HR people or the providers. It is a tax-free transfer. You really have to work hard to mess this up. You want to do a direct transfer to an IRA, if that's what you're deciding to do. That says transfer. This word says transfer. I promise. Let me rewrite it. You want it to be a direct transfer to an IRA. That means it's made out to, the check is actually made out to XYZ custodian for the benefit of J. Smith. Right. So you can't, even if you receive that check, which sometimes you have to, like Fidelity, for example, they have to, they require, even if it's being rolled into an IRA, they don't mail the check to us. Some custodians do, or some providers do. But Fidelity, for example, is the largest 401k provider out there, but they'll send it to the client, and then the client then has to send a check to us. No big deal. The client can't deposit this into their into their checking account because it's made out to the custodian. We use Charles Schwab for an example, so this would be Charles Schwab and Company for the benefit of Jay Smith. But it is a tax-free transfer. There are times when you'll call and they'll say, well, we have to withhold 20% because it's a distribution, and that you should almost just hang up and ask for another person because that person does not know what they're talking about. That is a tax-free transfer. You have to consider fees and costs. There are fees and costs in your 401k plan. There are going to be fees and costs with your new IRA. So whether it is simply trading costs and you're doing it yourself, or if it is advisory fees for financial planning fees, and you're hiring a professional to do it, you have to evaluate that. But don't think for a minute that there are no fees in your 401k or your other retirement plan. So you should line it up. Here it is. 401k, IRA. My 401k is going to cost me, 1%. My new IRA is going to cost me 1%. My 401k has admin fees of, that's not 1%, say 0.10%. There's additional fees, in this custodian of, 0.5%. Who the heck knows? And then you have to compare and you have to see, a value or not of rolling that over to an IRA from a cost point of view. But there are almost all 401ks have a cost, and almost all IRAs have a cost. You've got to look at what the benefits are, right? From one to the other. So be aware of the fees and costs. Flexibility. Flexibility may be a benefit. So flexibility of investments. Investments for sure. And you might also, let me add advice in here. So it could be that many 401k providers will offer some level of investment management. So they'll say, rebalance your accounts. We help you, we put together mutual funds or the fund choices within that. And we'll manage that, and they charge a fee. Then you have to determine if the advice that you're paying for outside of the IRA is more than just investment advice. I always say it's shocking to me that these large firms say, we don't give tax advice. They write it. They disclaim it. We don't give tax advice. When taxes is going to be, and anybody's, one of the largest expenses during retirement, and they just hands off it. Because it's complex. CPAs don't even know the rules, right? Some CPAs don't even know the rules. So they don't want to get involved in it. So you've got to see if that advice is worth paying for, or if it's not, on both sides of that ledger, right? The 401k and the IRA. But flexibility, you know that in most cases, your 401ks have a lineup of mutual funds. You're going to have a bunch of, age-based funds or goals-based funds, the 2050 fund, the 2045 fund. And then you may have some individual choices that you have to go in and choose yourself. Whereas if Debbie wants to, as she asked about investing in gold and silver, this is not a recommendation, but if she couldn't do that in her 401k and she wants to do it in her IRA, she could do that. So she's got greater flexibility. And as we talked about, advice, more access, potentially more access. So you can access your IRA. You can do, we're going to talk about Roth conversions. But your access to your funds could be greatly restricted inside of your retirement plan. The worst offender to this is, and you've heard me say it, is TIAA-CREF. TIAA-CREF commonly holds on to the money that they are trusted to care for. And there are many, many, many examples of people that are deep into their retirement, well over 59 and a half, and they can only access 10% a year of their own money in retirement. So your access can be very, very limited. Whereas if you're able to roll that over to an IRA, you really have full access to it. You can make your own investment decisions. With or without a financial advisor, financial planner, and you can make your own distributions. It might be very, very complicated to get the your own funds out of the 401k, even if it's not restricted, just because you have to deal with plan custodians. You have to, somebody has to sign off on it. You have to send it to HR. You have to listen. I'll share an example. We were rolling my own wife's 401k over from her previous job many years ago now to her 401k that we have as a company. And God bless him, that custodian the plan sponsor, the company she used to work for, it took years to get them I am not exaggerating, years just to get them to sign off on the paperwork. It would, they'd put it aside. It would get lost. I would call, come on, what are you doing? And it was a big deal. So the access is important. And you could do Roth conversions. Now, you might be able to do Roth conversions in your plan as well, but that is really uncommon. So you want to figure out your own schedule and what makes sense for you. Pay the tax. Yeah, of course, have to pay the tax, but whatever makes sense for you. But this is Roth conversions are much easier to schedule and do in an IRA compared to a 401k, even if you can do them in your 401k. Now, don't mix these up. If your plan allows for Roth contributions, you still are probably not able to do conversions. Few plans allow conversions, and few plans, if they do allow conversions, allow you to do them over time. It's typically a one and done scenario. Sitting here today, April 18th, 2023, that could change. So Roth conversions, you have more flexibility to do Roth conversions and do some tax planning for sure. Tax planning. Now, Ed has a point in there that says estate planning is easier in an IRA, and I want to ask him about that when I see him next week, because I'm not quite getting that, but that's okay. I'll ask him. Now, in the on kind of the pros side of the 401k or rolling it to an IRA. Well, actually, let me go back. So this is still a pro of rolling to the IRA, is NUA, or net unrealized appreciation. So if you don't know what net unrealized appreciation is, you can actually go into our special webinar section on attleborowealth.com. I did a whole discussion with, I think it was Andy. Yeah, I think it was Andy Ives, about net unrealized appreciation. So what is net unrealized appreciation? Net unrealized appreciation is when you have a company stock in your 401k plan. It may make sense for you to distribute that company stock into an IRA, or distribute that company stock into a non-IRA account. You have the ability to you'll pay ordinary income tax on your cost basis. It gets complicated. That's why I want you to go to that webinar, but you pay ordinary income tax on that cost basis, just like you earned it, but you pay capital gains on any growth of that company stock. So if you work for Apple, for example, it's not a recommendation to buy or sell Apple, but if you worked for Apple, for example, and you had Apple company stock and it cost you $10,000 and now it's grown to $1 million, well, you would only pay earned income tax on that. Earned income tax. Wow. Ordinary income tax on that $10,000. You would pay capital gains on the entirety of the growth, and you can schedule that capital gains tax. The only thing you have to pay tax on in that first year would be the ordinary income. So again, that gets confusing, but you can, if you roll your funds over to an IRA, you can take advantage of net unrealized appreciation. And hopefully you're having a discussion with a financial advisor well before you retire, because I hear people all the time saying, oh yeah, I had a bunch of company stock in there, but I did what everybody said to do, and I reallocated it into other funds, and now you've given up that opportunity to take advantage of net unrealized appreciation, if that makes sense for you. So I understand that's a confusing one. Spend more time on that. If you have questions about that, go to that webinar that talks about net unrealized appreciation. And if you still have questions, you can reach out to us at questions@attleborowealth.com. Backdoor Roth IRA contribution considerations. Be careful if you think that you're going to still be working. Say that you have this IRA 401k plan at a previous employer and it has $1 million in it, and you're saying, I'm going to roll that into an IRA, but I still want to make Roth contributions. And I did a whole webinar about backdoor Roth contributions, I think in November. So you can go find that if you don't know what I'm talking about. But if you take that $1 million and you roll it into the IRA, it's going to completely mess up your opportunity to do backdoor Roth contributions because of what's known as the pro rata rule. And the pro rata rule says that the IRS looks at the entirety of the IRAs when they consider how much of your conversion is taxable. But if it's kept in the 401k, then it is not considered at all. So that may be a good reason to keep the money into your money into a 401k. And then we have the age 55 rule. So you can't access your funds in most cases prior to 59 and a half if they're in an IRA. But if you retire at age 55 and your money's in your 401k, you can access it without a 10% penalty. So if that's important, and it could be age 50 for certain government employees, police, fire, etc. So that's important. If you think you're going to retire early and you want to start taking distributions, you may not want to roll that 401k over to an IRA so you can have access to your funds prior to 59 and a half. And then you have the still working rule. So if you have $1 million and you roll that into an IRA, if you're still working, say you're 73 years old and you're still working, well, now that's rolled into an IRA. At 73, you have what? You have RMDs. But if you kept that $1 million in your 401k and you're still working and you don't own 5% or more of the company and you're still age 73, then you have no RMDs. That's the still working rule. Okay, so there are lots of considerations when you're considering rolling over your 401k to an IRA. Some of the big ones, as I said, were fees and costs, flexibility, access, the ability to do some tax efficient planning. You know, I just came off a class, so I've been meeting with a lot of people, and time and time again, I'm showing people that just by doing things more tax efficiently, not spending less in retirement, not taking more risk in investments, just situating your assets from traditional IRA to Roth IRA, for example, over time can have a significant impact on the potential for your retirement. Sometimes it's millions of dollars. I've had, $1 million, $2 million, $4 million, $5 million difference by age 85 or more, just by doing things a little differently. So flexibility is very, very important, and 401ks can be very restrictive. So flexibility, access, not flexibility just in investments, but also, when you can access, what your schedule can be for Roth conversions. Again, even if you're going from a 1% 401k to the 1.5% all-in cost IRA, it still may make sense for you because people get really tied up in the individual fees, but they don't think about the benefits sometimes. And even with the paying a little extra fee or paying an advisor, so like myself, a financial planner, a fee, when you can see an potential increase in your retirement assets at certain ages of $1 million, $2 million, $3 million, $4 million, holy cow, what's that worth to you? Rather than, what's that penny wise, pound foolish kind of thing, right? So you've got to evaluate that. So access, Roth conversions, net unrealized appreciation. I think that's probably something that's sometimes a little overused, but when it works and makes sense, it can save you a tremendous amount of tax dollars. Backdoor Roth IRA contribution considerations. It may make sense to keep money in a 401k if you're continuing to do backdoor Roth contributions. The age 55 rule and the still working rule regarding required minimum distribution. So some of the key issues, as I showed you, there's 7 pages of considerations from our Slott group module. I think I also did a snapshot here of the age 55 rule. I did the age 55 rule. So there's a lot of considerations, but it's an important consideration. You should take it seriously. And if you have any questions about it, obviously you can reach us at questions at attleboroughwealth.com. If you want to schedule some time to meet with me, you can do so at questions@attleboroughwealth.com. And other than that, we'll see you next week. It's 10:55. Have a great week. I hope the weather gets a little warmer. I know we're in Pennsylvania, so it's going to be 87 tomorrow or a Friday, and it's cold this morning. I had the space heater on here because it's cold this morning. But I hope you all have a great week. I hope this was helpful and beneficial. Love to hear your comments. So you drop a comment in that comment section of the YouTube video, or hit the like button. We like likes. I'd love to hear what you're thinking. All right. Have a great week. Take care.